When the majority of people buy stocks, they start by looking at the stock price. McDonald's is trading at $250 a share, but Sweetgreens is trading at around $30 a share. But that is the worst thing that you can do as a stock market investor. I'll show you why, and I'll show you what you should do instead. A company's stock price does not show you if you're overpaying for the stock. It doesn't show you if the company is making money, and it doesn't show you if it's a good investment. All a stock price tells you is how many shares there are in that company. If I start this company and it's worth, let's say, $1 million, I could go out and issue 1,000 shares of my company, meaning I can slice up my company into 1,000 different shares, which means now you take the value of the company, $1 million, divided by the number of shares of this company, which is now $1,000, and that means each share is worth $1,000. But what happens now if instead of creating 1,000 shares, I go out and I create 500,000 shares of my company? That means each share is a smaller slice of my company, and now you take $1 million, the value of my company, divided by the number of shares, which is 500,000, and that means now each share is worth only $2. See, the share price doesn't really show you anything about the company. All that really shows you is how many shares there are. If a $1 million company is broken up into 1,000 shares, each share is worth $1,000. If this $1 million company is broken up into 500,000 shares, then each share is worth $2. That's why if you really want to find a good investment and build real wealth in the stock market, there are 3 numbers I would rather you pay attention to. Number 1 is the market capitalization. Number 2 is the number of shares available. And number 3 is the profit. All of this information has to be publicly available for every company that trades on the stock market, because if you trade on the stock market, you're considered a publicly traded company, and the United States government requires a certain number of regulations which include publicly disclosing this type of information, and I'll also show you how to find this data and more in just a little bit. But it's not just understanding these numbers, you also have to understand how to apply these numbers. That way you can find a good investment versus a bad investment, an overvalued stock versus an undervalued stock. And so let's jump right in. But I gotta give you the disclosure. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. A simple and basic way to understand if a company that you're thinking about investing in is overvalued or undervalued is by comparing these numbers from one company to another within the same industry. So what I want to do for the purposes of this video is I'm going to compare McDonald's, I'm going to compare Chipotle, and I'm going to compare Yum Brands. I'm not telling you what to invest in. I'm just doing this for example purposes. By the way, Yum Brands is the company that owns those franchises like KFC and Taco Bell. So let's start with McDonald's. From Yahoo Finance, I can see that the market capitalization of McDonald's is around $185 billion. A quick Google search will show me that there are about 720 million shares of McDonald's outstanding, and a quick Google search also shows me that in 2023, McDonald's made a $14.5 billion in profit. So if you buy one stock of McDonald's, what you're doing is you're buying one share of the McDonald's corporation. You're buying 1/720 millionth of the ownership of the McDonald's company. So if you divide McDonald's into a pie, you slice it up into 720 million different pieces, you buy one share, 1/720 millionth with every share that you purchase. See, most people are thinking, oh, I'm buying this company at $250 or whatever the stock price is, when in reality, what that stock price is actually telling you is it's the market capitalization, which is the valuation of the company. This is how much McDonald's is worth according to whatever the stock price is today. This is the valuation of McDonald's. That's what the market cap is. You take the valuation, you divide it by the number of shares, that's the share price. If McDonald's were to reduce the number of shares, well, then the stock price would go up. If they increase the number of shares, if they divide it up into now 1 trillion shares, well, now the stock price would naturally fall. So instead of just looking at the stock price, you want to understand the relation between the valuation and the number of shares, but you also want to take a look at the profit. Because if you've ever seen Shark Tank before, you've probably heard the sharks say, I'm willing to buy your company at a 5 times multiple, at a 10 times multiple, meaning at 10 times profits or 5 times profits. That's how much they want to buy the company at. So now when you're going out and investing in stocks, you're doing the exact same thing, but many times people get caught up in the share price when instead you want to understand what is the valuation of the company and at what multiple are you buying the company. And the way you can figure that out is just by taking a look at the profit and the market capitalization. So now if you take the value of the company and you divide it by last year's profits, then you get kind of a rough multiple based off of last year's numbers. So let's do the math. Take the value of the company, you divide it by the profit, which is about $14.3 billion. That tells us that McDonald's is selling for 12.5 times earnings, roughly. Now the question is, are you overpaying or are you underpaying? And this is where, when you want to compare if you're overpaying or underpaying, you want to look at some of the competitors in the same industry. Because if you compare McDonald's to Netflix or Lululemon, these are companies in completely different industries which are going to have completely different multiples. But one of the things you might want to consider doing is looking at other companies within the same industry to see if McDonald's is more expensive or more cheap. Because if McDonald's is selling for significantly higher than all of its competition at a much higher multiple, then it might be more expensive. Versus if McDonald's is selling for 12.5 times earnings, but all of the competitors are selling for 40 times earnings, McDonald's might be a little bit cheaper. Now, I do want to caution you before we go deeper into this, this isn't the only analysis you want to do. This is just one piece of analysis, because then you can look at other things like, what are the assets that McDonald's have? What is the intellectual property that McDonald's have? Are they innovating? But we'll get into that in just a little bit. So let me compare McDonald's now to something like Chipotle, a younger, more startup-y type of company. So now let's do the same research for Chipotle. Yahoo Finance tells us that the market capitalization for Chipotle is right around $90 billion. A quick Google search tells us that Chipotle has around 27.5 million shares outstanding. And a quick Google search tells us that in 2023, Chipotle made around $2.6 billion in profits. Now, if we were to judge these solely by stock price, Chipotle would look a whole lot cheaper because it's trading for around the $60 a share versus McDonald's is trading closer to the $250 a share. But remember, the stock price is really just the market capitalization divided by the number of shares. It's not really an indication of the profits or how good the company is. So instead, let's take a look at how expensive the Chipotle company is, but taking a look at what multiple it's selling for. So if you take the market capitalization, $90 billion, you divide it by the profit of $2.6 billion, what that tells us is that Chipotle is selling for about 34.6 times earnings, while McDonald's is selling for 12.5 times earnings. Now let's do the same analysis for Yum Brands. Yahoo Finance tells us that the market capitalization is $37 billion. Google tells us that the number of shares outstanding are $281 million, and Google tells us that the profit is around $5.3 billion. Again, the stock price is just the market capitalization divided by the number of shares. But if you want to see how expensive it is, taking a look at the multiple, now what we do is we take the market capitalization, $37 billion, you divide it by the profit, which is $5.3 billion, which tells us that Yum is selling for around 7 times earnings. And this is where most people stop, but this is just the beginning of your analysis. Now, I do want to let you know that for those of you that are money nerds that want to stay up to date on what is happening with economic trends and stock trends, we have a free newsletter at Briefs Media called Market Briefs, where my team is working to break down what's happening in things like stocks, the economy, housing, crypto, and the global economy into a fun, reading, and easy to read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. This is now a starting point for your analysis. This is not the ending point for your stock market and investing analysis, because the reality is there's a lot that goes into these valuations, because startups generally have higher valuations than more established companies, like you can see here, because when you're more of a startup, then investors tend to bet on your future growth versus the growth that you have today. When you're more established, then investors are generally betting on the returns that you have today. So now, you as an investor have to come up with your own investing criteria, because remember, you're not just buying a ticker symbol, you're not just buying a stock, you're buying a share or a piece of ownership in a company. So now you want to do your analysis into the business as well. For example, what are you actually investing in? Because when you're investing in McDonald's, you're not just investing in a burger business, you're also investing in the real estate, because McDonald's owns the real estate that they operate out of. So when you're investing in McDonald's, you're not just investing in the burger business, you're investing in the real estate business as well. When you're investing in Chipotle, you're also investing in their automations and systems that they've built. When you're investing in Yum, you're investing in their acquisition strategy, because Yum isn't just one company. They're investing in companies like Taco Bell, Pizza Hut, KFC. So they own multiple different franchises. And this is where, if you really want to be a successful investor, you have to put your investor hat on and really start analyzing and diving deep into the companies that you're investing in and go beyond just the financials that you see here. For example, you want to start studying things like the executive structure, Who is the CEO of the company that you want to invest in? Are they a good CEO, bad CEO? Are they driven? Are they not driven? You can learn about them on LinkedIn. You could read their book. You could check them out on Instagram. You can check out their blog posts. You can check out what news articles have said about them. You can start studying what they do because they are the captain of the ship. And if they are leading this company into a bad direction or into a vision that you don't agree with, you probably don't want to invest in it. You should also study their innovation and their intellectual property. How is this company that you're thinking about investing in innovating? And are they creating any sort of intellectual property to make it more difficult for their competitors to compete against them? You can take a look at the cash usage, because every company has to publish 3 different types of financial statements. They have to publish the income statement, the balance sheet, and the cash flow statement. The income statement is your profit and loss statement. It shows you how much money you made, where the money came from, and it shows your expenses. The balance sheet is like a net worth statement. It shows the assets and liabilities, and the cash flow statement shows how the cash flowed through the company. Take a look at how the company is using debt. Are they way overloaded on debt, or do they have a manageable amount of debt? Do they have a lot of expenses and growing expenses, or is it a manageable number of expenses? And how are they using their cash? Are they investing in the future growth, or are they just kind of cruising now? One of the things I like to do here is also to take a look at revenues, expenses, and profits, not just right now, but over the last number of years to see if they're growing, shrinking, or staying the same. Because I want to be investing in a company that's working to grow and that's going to be worth more money in the future. That means if a company's revenues are shrinking, that's a bad sign. If a company's revenues are growing, that's a good sign. And if their expenses are rising, I want to know why they're rising. Is it rising because their cost of doing business is rising, or are they rising because they're investing more money back into the business? Now you're going to ask, well, Jaspreet, how do I find all this data? Well, the way you find all this data is by looking at a company's financial statements or looking at their earnings releases. Every single company in the stock market has to release what's called a 10Q and a 10K. A 10Q is their quarterly report. A 10K is their annual report. And inside of these reports, you will find all the information that I told you, and all of this is publicly available. You can look at it on the company's website itself. For example, if you go to McDonald's website, you'll see an investor relations tab, or you can go to the SEC website and find all the information there. Let me just show you. This is from McDonald's annual report, and what I can see is that in 2023, their revenue increased by 11%, their costs stayed essentially the same, and their income before taxes is up. And these reports are where a lot of investors spend a lot of their time. You don't want to just study what a lot of the news agencies are publishing because they like to nitpick and show the headlines showing numbers. You want to dig into the numbers and come up with your own analysis for yourself, which I understand there's a lot of work. I'll show you an alternative in just a minute. But this is where if you want to be an investor and you want to invest in individual companies, you got to understand what the company is doing. Because you can also get a whole lot more granular and get a whole lot more nitpicky inside of these reports. Take a look. Going deeper into McDonald's annual report, you can see the revenue from McDonald's operated stores versus franchise McDonald's stores versus international revenue. This way you as an investor have more information to actually do your analysis. Now you might say, well, Jaspreet, this looks like a lot of work. I don't want to do this. In which case, you probably don't want to do it. What I like to say is that 98% of people should not be going out and investing in individual companies because they have no idea what they're doing. They have no idea what they're investing in. But if that is something that you're interested in, well, this is the start of your analysis, not the end. It is the start. And the reason why people like to invest in individual companies is either because A, they like it, or B, they like the upside potential. But there's also a lot more risk, because if you put all of your money into McDonald's and then the real estate goes bust, they take on too much debt and they go bankrupt, you lose all of your investments. This is where the alternative is, instead of investing in individual companies, you can invest in funds. For example, there's an ETF, a fund called EATS, E-A-T-Z. If you invest in this one ETF, you'll get exposure to a whole basket of restaurant and food service companies. So if you invest in EATS, what do you get? Let me show you. Brinker International, Kava Group, Wingstop, Dutch Bros, Chipotle, Aramark, El Pollo Loco, Texas Roadhouse, Domino's, Yum Brands. And that's just page 1 of their holdings. So what I want you to understand here is that there are a lot of ways for you to go out and invest in stocks. And if you want to invest in individual companies, that's great. But I want you to look beyond just the stock price. I want you to look at, what are you actually buying? Are you buying it at an overvalued or undervalued price? And we went over some strategies to kind of start that. And if you don't want to go out and invest in individual companies, well, there are funds out there. I'm not recommending EATS, just giving you an example. There are many different types of funds out there that you can invest in that can give you exposure to a broad basket of whatever it is that you want to invest in. That way you don't have to spend all the time, effort, and energy to find the individual companies. By the way, if you want to learn more about how do you actually analyze funds like this, I already made a video covering that, and I'll link that for you down in the description. In the early 1930s, we had the Great Depression, we had the market crash. But then in the 1970s, we had another market crash because of the high inflation and the slowing economy. This was an era of stagflation that really hurt the economy. 2001, we had the dot-com bubble burst. You can see the market crash again. 2008, we had the real estate meltdown. But after each time, you'll see that the stock market recovered.